Thank you.
Thank you, Ms. Professor Hölscher. Dear gentlemen, we have a new challenge here, a 33 hours working day. Well, I can rest assure you we're not trying it today on you. So let me, for the last word of today, before we hear the farewell, call on Professor Dr. Claudia Buch. She's a distinguished scientist before she's been called on the board of the Bundesbank, and it's its deputy president today. Warm welcome.
Thank you very much. Thank you very much for inviting me to give a talk here, for you to stay through, as I see from the program, a very interesting and exciting conference, in particular for all the previous participants for staying exactly on time. So I'm really impressed giving the last word after a long day, and it's perfect timing, so that shows some discipline here in the room. Yeah, so hearing a bit what has been discussed on the panel, I wonder how many very new ideas I can bring to the floor here, because the topic of this conference has been how to foster growth in a new regulatory framework, and I'd like to discuss this question from the point of view of my new role as a regulator, as being in charge of financial stability at the Bundesbank. But I'd also like to draw on the vast body of literature that we actually have to answer this question. So what is the link between finance and growth? What can we do to contribute with the right regulatory framework? And let me start with one number, and then I will go more into the broad picture in terms of the evidence that we have. Let me just remind all of us that actually the financial crisis has been very costly, and usually we think about it in terms of the cost for the taxpayer and the increase in public debt. But it has been very costly in terms of the loss in output. So there are lots of estimates around, and of course we all know that estimates have a margin of error, but on average, the output loss of the financial crisis has been estimated at 8.4%, or let's round to 8%. It doesn't really matter for the precise number, but it's pretty clear from all the studies that we have that there has been a persistent drop in output, and it's not only cyclical. We also have a lot of evidence that it's a structural decline in the potential output that we have seen. And the question is, of course, why is that? What are the channels? Why is it that the financial sector is so important for the real economy? And of course, what comes to mind first is that, well, of course, the financial crisis has destroyed part of the capital stock, and it takes time to rebuild the capital stock. It takes time to increase innovation and productivity, and that's of course the first channel, but that again doesn't really help us answering the question what exactly is the link between the financial sector and the real economy, investment, innovation and productivity. We tend to think that we have understood this link because we have implemented many new regulations, and I just want to drop a few terms here, and you all know much more about the details. Many of you also to some extent suffer on the details in terms of having to fulfill with the new regulatory requirements that come with new regulations, that come with the banking union, that come with the capital markets union. I will return to these terms, but I would like us all to step back a little bit and think about, well, what are the guiding principles that we have for these reforms? So it has often been argued that the new reforms are too complex. The regulatory system has been very complex going into the crisis. We've added to some extent a layer of complexity because now we're also dealing with financial stability and with macroprudential regulation. And of course, it's useful to take a moment to reflect on, well, what are the guiding principles for this regulatory reform? What should we be focusing on? And here, I mean, excuse me, but this is my background here. I'd like to rely on evidence, on empirical studies that we have available. And I would like to talk about two links. One is the link between the financial sector and growth, and we've already heard a couple of links here being discussed. And then I also want to discuss, well, if we've understood the link between the financial sector and growth, might there be also something like a double dividend in the sense that if we're making the financial sector more conducive to growth, would that also help to enhance the stability of the financial sector? So otherwise we would be in trouble because we would be reaching one goal while having to sacrifice the other. And the good news is that actually, yes, there are avenues for reforms which would actually help us to achieve these two goals, allow the financial sector to contribute more to growth and also to make the financial system, the economy, more resilient and more stable. And you can almost guess, I guess, what is the key link here, and that's of course equity finance, or shifting the focus of the financial sector away from debt finance towards equity. But this of course is also a bit too short of an answer. We have to be a little bit more specific. Let us go back a little bit to the, well, maybe early 90s, when before the recent era of globalization, and let us think about, well, what was the thinking about financial development and economic growth? And when you look at those discussions, both the policy discussions and also the academic discussions, you would find a lot of talk about financial development and how conducive financial development is to economic growth. And there were actually a lot of empirical studies showing that the larger the financial system, the faster growing our countries. And a key indicator that people used at that time was credit over GDP. Now, when we now talk about credit over GDP as a measure for financial development, we are perhaps a little bit more skeptical whether it's the right indicator or whether it's actually continuous, a linear relationship between credit over GDP and growth or development. And that is actually something, so this concern that you might have, well, if this financial sector grows beyond a certain size, then maybe it is detrimental to growth and also detrimental to stability. That's actually also something that has been shown in the literature. There's lots of empirical evidence showing a non-linear link, or to use a more vivid picture for that, having too much credit is a bit like having too much water, having too much liquidity. Of course, we need credit, we need liquidity, we need water for life, but there can also be an overdose, and there can actually be water intoxication, which can be very dangerous. And so the question we have to ask ourselves, so why is it that at a certain point the financial system, or be more specific, the financial system that's intermediating credit is having a negative impact on growth, on development, and I will later talk about that, on financial stability. And so it has been mentioned on the panel already. Also a while ago, at the time of the financial crisis, Paul Krugman coined the term boring banking. So boring banking meaning that this is the traditional banking business, banks taking in deposits and giving out loans to firms, and then stimulating positive firm dynamics and innovation. And apparently banking has become more exciting, but banking has also become more risky, and the question is why. And so what you see is that certainly the explanations come through both the structure of banks' assets, or the financial sector assets, and the structure of funding. So we've been seeing an increasing move into non-traditional banking activities, an increase of wholesale funding, and it's pretty clear that banks, financial institutions relying to a large extent on wholesale funding are more prone to shock. So those were the banks that have cut back lending most during the crisis. So this move into non-traditional banking activities has certainly been one feature. But then we also see, as countries grow richer, as the financial system develops, there's often a move from corporate lending to household lending. And there's very interesting evidence for the US and also for other countries, showing that the larger the share of credit financing consumption, the more the greater the probability that there's a negative impact on growth. And that's also easy to understand when you think about what the financial system is supposed to do. Of course, it's relatively easy to find productive, innovative firms as long as you haven't reached the productivity frontier. But once you are at the productivity frontier, and we just on the panel we heard a discussion about what is an emerging market, what is a developed economy. So maybe the distinction is that some countries are at the productivity frontier, and then it's much more about innovation and creating new products than just imitating what has been there before. and the more difficult it becomes for the financial system and for the banks to generate those firm dynamics that are needed to generate more growth. So that's one additional explanation, the shift from corporate credit to household credit. But then there's also an interesting study for the US, and you've probably heard about that, a study which shows the changing skill distribution of those working in the financial sector. So at the time when there was boring banking in Krugman's terms, there was actually a much different skill structure in the financial sector than during the period of the early 20th century, when there was also more exciting but also more risky banking activities, and also compared to the period since the 1980s. So there's also some likelihood that this shifting of resources of the high-skilled people to the banking sector away from innovative, productive activities is one explanation for the detachment of the financial sector from the real economy. That is the issue we are talking about here. But of course, all these explanations, changes in the structure of assets and the structure of funding and in the people who are employed in financial services, that shouldn't leave us disregarding the role of regulation and the public sector safety net, and that's of course what's our part in the picture here, that of course our joint effort has to be to reduce incentives for risk-taking that also result from the public subsidies, implicit, explicit, that we have in the financial system, and that result from the regulations in the system. And you may have seen that we've published our annual report last year, and there's a long section about actually very simple role of regulation when it comes to incentives, and that's the preferential treatment of sovereign bonds in the current regulatory framework, which I think is a feature of the regulatory system which is known to all of us, and it's very simple to illustrate that this is where also misaligned incentives are being set. So in a nutshell, the evidence that we have, what we've learned from the development of countries, tells us that, yeah, so if we have an excessively high share of credit in the economy, that can be detrimental to growth, and the financial system at some point doesn't fulfill its role anymore to stimulate innovation and investment. Having said that, it's of course, and this I think has been very nicely reflected on the previous panel, we can't say that just moving up the pecking order of finance up to equity finance, this is always the right strategy. Again, there's a very much of a non-linear link, and the model that is right for a certain set of countries at a specific point in time might not be the right model for other countries at different points in time. Just witnessed the discussion that the Eastern European economies had when they were deciding on what financial system to opt for in their regulation in the early 90s. There was also a very intensive discussion about whether a market-based or a bank-based system would be the optimal structure. But let me come to the second question. So what is the link between financial structure and financial stability? And not least since the work and the writings of Ben Bernanke, we know about the financial accelerator. The financial accelerator basically is a mechanism which is telling us that a seemingly small shock can have a large impact on output, and it's more effective the more credit-financed a financial system is. And here it doesn't really matter whether the credit financing comes through the financing of consumption, private or public, or investment. It is generally the case that the higher the share of debt finance, the stronger are these amplification effects, and even worse so, the stronger these amplification effects running through the financial system are even stronger the less capitalized the banking sector. So this is why we have, with all our reform efforts, opted for more capital in the banking system, so that seemingly small shocks hitting the system don't have these large amplification effects. But when we talk about the role of debt versus equity finance, so let me just take that distinction here. The key issue, of course, about equity finance is that it provides an ex-ante risk-sharing mechanism. So the claim I have as an equity owner is tied to the fate of a particular project, whereas as a creditor I have a fixed claim. So we've kind of a built-in mechanism for risk sharing, which would actually be having more equity, having had more equity finance would also have been beneficial during the European financial crisis, about which we've talked about the role of Europe for the world economy, and somebody mentioned that maybe Europe should more think about its role in the global economy. I think there's also a lot of thinking we still have to do about Europe's internal problems, and just from the point of view of the discussion here, it would have been very beneficial as a stabilizing feature on Europe's capital markets had we had more equity finance, also cross-border equity finance. So when you look at the capital flows and how they have evolved during the crisis, there was much more of a capital flight element with regard to debt markets rather than equity markets, and in particular in a monetary union where the exchange rate can't adjust, that would be an important adjustment mechanism to cushion regional macroeconomic shocks. So the bottom line would be, if you take these two lines of argumentation together, the link between the financial system and growth and the financial system and stability, there might indeed be a double dividend if we would achieve to move the financial system more towards an equity-based financial system. So let me quickly go through a couple of implications this has for the regulatory debate, and I would like to start with the banking union. So this is the project which has taken a lot of time and effort for most of us here in the room. For me, the banking union is important for two reasons in terms of addressing our problems. The first reason is that through the single supervisory mechanism, the banking union allows us to detect risks earlier on. So that was one shortcoming of the previous fragmented system, that we didn't really take a European perspective at addressing risks on banks' balance sheets. But of course, detecting the risks and possibly detecting them earlier on doesn't yet allow us to deal with those risks. So we also didn't have a proper mechanism of dealing with the risks that have emerged on banks' balance sheet, and that's the second pillar of the banking union. That's the resolution mechanism, which is also providing us with tools, in particular the bail-in tool, to enhance risk sharing and to enhance private sector risk sharing. So in that sense, it's actually a stabilizing mechanism because it provides us with the instruments that we have to have available in order to deal with a possible debt overhang. Then we also just with one sentence mention macroeconomic policy, because actually the banking union also has a role for macroprudential policy, because it's not only looking at the distress or the difficulties in individual financial institutions, but the banking union also has a role in macroprudential policy, i.e. ensuring that the financial system as a whole doesn't have negative implications for the real economy. But of course, the banking union doesn't do all the tricks, it doesn't solve all our problems, and this is actually why I think the capital markets union is important. So I think the capital markets union, and again, this is a very fuzzy term which enters many policy discussions, but for me, the capital markets union is a possible way to go exactly into the direction that I have mentioned, namely enhancing the development and the integration of equity markets. Of course, we live in a single market for capital, so the direct barriers to the cross-border investment of equity have been abolished, but we all know from our practical experience that there's still many open avenues, and let me just mention two issues which I think are important when it comes to debt markets. I think we still have a way to go to really have an insolvency regulation and insolvency regimes that allow banks to deal with non-performing loans, and that's actually on the agenda of the Capital Markets Union, although it's of course a very difficult topic because it requires changes of national legislation. let me end with something which is on my wish list and which is also a very difficult political issue, but that's the tax treatment of debt versus equity. So I think if we're thinking about moving the financial system more to a system which is more conducive to growth and to stability, that also requires changes in tax system. And this is actually where national policy plays a role in Europe. So this is also, I think, a discussion that we should have in this context. But now, having praised everybody for staying exactly on time, I'm not sure whether I've overdrawn maybe like 3-4 minutes. I hope you forgive me. But I could just touch upon a couple of issues, but maybe this is food for thought, not for today, because this is the last word, or almost the last word, but maybe for follow-up the discussions that we will have. And for now, I thank you for your attention. Thank you.